Hey, welcome back to Two Super Guys Trade Stocks. I am Dylan.
And I'm Vinny. And with all the blood in the streets right now, as far as stocks selling off, particularly in the banking sector, the question starts to become, how do you value a bank and when is a good price to buy this sort of stuff? So we're going to talk a little bit about that today and look at some charts too.
Two Super Guys Trade Stocks.
All right, so my main man Warren loves banks, so we're going to talk a little bit about play on that, if you will. So basic premise when you're valuing a company, there's kind of a few ways to do it. Just DCF, discounted cash flow, that's the most common one used for garden variety companies. Comparable company analysis, you're comparing kind of apples to apples to the best of your ability if you can. And then precedent transactions is when you're looking at companies that have been bought out. Right, and that's not exactly something you can really use in this environment because no one's bought a large bank in the last couple of years that I'm aware of. Put it that way.
Although it might happen
Yeah.
here, so
Yeah, there's definitely some consolidation. So banks are traditionally valued with something called book value. Book value basically is, if you take all the assets the company has, sell them off, pay off all the liabilities, you end up with a pile of cash at the end. That's the book value.
got it.
All right. So typically that's kind of how you value banks, with a ratio upon that. And you have to look at the historical average for each individual one to kind of get a lot there. So there's definitely some drawbacks to book value. All right. One of the major ones is that there are things outside of that will be included in the book value, right? Like say, JP Morgan, that name has a value. And that wouldn't be included in the book value because you can't just sell the name JP Morgan, and get the full value for that. It's kind of hard to do that.
Right, makes sense.
There's a discount. It becomes certain companies have much more valuable brand, if you will. The other real major one that becomes a kind of sticky issue in this realm is this mark-to-market accounting. All right. I just watched The Big Short last night. It's a really kind of interesting, thought process there. Do you remember, like in The Big Short, how there's that period where there's the underlying mortgage bonds are decreasing in value because the mortgages are failing, but the Goldman Sachs and all these credit default swap companies that he had bought the credit default swaps from for Michael Burry there, they were not increasing the value of those. Do you remember that?
Sort of, kind of.
Well, he's like, we may be just be in a fraudulent market, right? Because when you're talking about stuff that is not very liquid, that is very dark, as one of the guys even talks about it in the movie, it's hard to put a good value on that, right? It's these aren't transactions where you can just Google it. This isn't a very fungible thing where there's like 8 billion shares of Bank of America out there. You can see what the last one traded for. These are much more like one-off transactions, like selling I don't know, the 1973 Carl Yastrzemski card or something. I don't know. I know nothing about baseball cards, but I'm just throwing an example out there of how nuanced this can be. So you're really relying on the bank in their own estimation of the valuation of these things. And they're valuing it for the normal market. They're not valuing this for a fire sale, right? If you get into bad kind of spirals, the value that you achieve by selling these assets can be very, very different from what's listed on the books.
I don't like that. That's kind of so. One, just for the record, for anyone watching this, I don't know any of how to value banks, so I'm also learning this for the first time. I've never tried. I don't like that I have to rely on the bank valuing the bank. Not a fan of that aspect.
Well, in theory, you shouldn't, right? In theory, you should do Michael Burry style and get the prospectus for a mortgage-backed security, read through all 1,000 pages of it, and try to understand what the value of that thing actually is,
Oh, jeez.
and then apply that to every other asset that bank has, because that's just one asset. You're talking about trillions of dollars when you're talking about these large banks and assets. So
I'll just
yeah,
go with
almost impossible.
what Jim Cramer says. He's never been wrong. Go with that.
No. Yeah, Bear is fine. So just a little brief example. This is super high level, right? So Bank of America, they actually have this nice snazzy little chart here in their 10K from last year. Bank of America has $3 trillion in total assets, right? Yeah, I know. When was the last time you saw a company that had that many trillions in total assets?
I did not know that.
Exactly. Yeah, this is how large a monstrosity you're talking about here. Total liabilities 2.778 billion. I'm getting these numbers from right down here, in case you were wondering. I'm looking on this chart. So 273 billion in shareholder equity. That's basically the book value. In this case, they also have preferred shares, so they kind of subtract it out and tell you what the common shareholder equity is. All right, 244.8 billion.
Okay.
Yeah. And then, you look at this. I got this from CNBC from today. This is their market cap, 242. So they're basically trading right around their book value when you're looking at it from that perspective. And this is a chart right here from Macro Trends, which agrees. Bank of America generally is trading around a book value of 1. This is a ratio of the book value to the stock price. So as the ratio goes up, you're paying more.
So that would be fair valued in quotations of where they're at right now, you could argue.
Exactly. Reasonable ballpark estimate. But the really kind of tricky thing with this is that not all banks have the same kind of book value ratio. Do you remember this dog? I think both you and I owned it at one point.
Yeah, I hate it. This was a stupid trade on both our parts. You talked me into this.
In theory, it should kind of trade closer to book value, and it never does. Citigroup here has been trading at a 0.5 average book value for the last 15 years. Like that's just what they do. They never achieve that full valuation, which is kind of funny.
This company sucks. I hate it.
Yeah, I've given up on them and ever hoping to achieve anything close to like actual book value again. And JP Morgan, kind of the opposite thing, where JP Morgan is seen as a best of breed and bank, financial fortress, according to Jim Cramer. They trade around a price to book value of 1.5. And, it's been that way for a while. That's just kind of what they do. They're always trading, like, for the most part, since 2017 here, above book value.
Okay. So it looks like after the crisis, they actually dipped to 0.5. So you could say if they dip to 0.5, buy it.
That's a reasonable assertion, I would say. Oversimplifying it definitely, but it's a thought when you look at
oversimplifying is what I do.
It's what we do on this channel. But yeah, you have to look at not only like I said, the price to book value, but you're also looking at it for that kind of in that individual company and the historical trend and seeing where they are there. So it can be a little twisty. If you want a couple other options of how to play this blood in the streets here, this is actually a bank ETF that you could potentially pick up and be a little more diversified, kind of a little protected from individual bank failures, but you're still capitalizing on the overall kind of fear in the market and getting it at a lower price than it's been any other time in the last year. This is still well above where it was COVID levels, but it's for last year 52-week low as of Friday.
All right.
One last idea. Warren Buffett, OG, the man who once had like 30% of his portfolio in bank stocks, has $130 billion in cash right now. And when banks are going to be looking for some confidence and some liquidity, he's in a position to provide both of those things. So this could ultimately benefit Berkshire Hathaway long term, which is something that I find kind of intriguing, if you will. Their deal with Goldman Sachs during the 2008 financial crisis, Warren Buffett talked about this. They were getting paid $15.86 a second in interest on the loan that they extended to them when they were on death's door, if you will. So the deals you can make when you're in his position coming up in the next like 6 months could be very, very envious.
Okay, I did not consider that. That is actually. That's pretty fascinating. We're going to take a look at some bank stocks that are possible, ones that I would definitely avoid also. Citi's up there. I'm not even going to look at the chart. Yeah. Just avoid it. It sucks.
Yeah. Citi is dead money to me.
Yeah, it's just the worst. All right, so XLF is the kind of one of the more popular ETFs for finance. It has all your major players in it. There's one stock that is getting killed more than others, and that's Schwab. Okay, Schwab was chilling at $78 before this happened. They're down to $58. That is massive. As far as I can see, I've looked for every possible thing that I can on the internet. We might find out more info later, but in addition to the SVB thing that's going on, they also had an $8.5 million block institutional investor leave while all this was happening. So the theory is institutional investors are pulling out of them specifically. You could take that as good. You could take that as bad, as a good opportunity, bad opportunity, whatever. Also, They also had a fairly significant amount of insider trading like 2 weeks before this. So multiple not great catalysts.
Well, their price to book value ratio has always been extremely high too, like a
Yeah.
5 or something like that. Yeah.
Yeah.
They're not a cheap bank by any
They're
means.
no, they're a premium bank. And also on top of that, I should say Morgan Stanley and a couple other analysts reiterated, I think on Friday, a 90 plus, average price rating that they still think that they're worth that. So as of right now, Schwab is the most interesting, but I need more information. I don't like how 8.5 million shares it's not enough for what happened. Like,
Yeah.
sure, one person could get cold feet, but that's a big drop. Here's your Bank of America. We, went around $34, $35 down to 30. Not bad. Wells Fargo, same thing, 47 to 40, not a crazy percentage. Now, Goldman Sachs, not moving that much.
Yeah, interesting.
Yeah, they're just kind of hanging out. And then here's your financial institution. Boom. They actually had an up day when everyone else was tanking. It's almost like people move from their finance woes and just put all their stuff in banks at JPM. They had a great day. They're like the only one.
That's definitely interesting. Maybe Jim Cramer's right this time. Maybe it is a fortress.
It's weird. Here's what I would not do. Okay. Now, yes, I am looking for deals. I am nowhere near pulling the trigger on any of these finance stocks, just to be clear. It's too soon. I don't have enough information. It's just gambling. I would not do regional banks because they seem to be getting hit more, and there's just less information as to why until probably next week. This is an ETF for regional banks. I don't think I need to show this, but SVB. Oh, wait, SIVB.
Yeah, did they just pull it?
Yeah, it's pulled because it was at $30 and they just got rid of it.
Yeah, it's gonna be interesting to see how that fares out, but not worth trying to go through a bankruptcy proceedings to see if you get any money back at all. Oh man, that sucks for the people that are invested in that.
Yeah, unfortunately, someone commented on our channel that they were going to buy. I just saw it this morning. It sucks. After the big day that they were going to buy some, so they would have gotten screwed. I'm hoping they did not pull the trigger on that. That seems like not a good idea. Here's a Signature Bank. If you see a crypto video, you see why this is very scary. They're also down about 35% in about 3 days. Pretty large. East West Bank is also a very popular regional bank. Once again, what is that? That's actually not as bad. They're like 77 to, wow, I can't believe I said not as bad. 77 to 62, right?
Yeah. Well, I mean, relative, when you're seeing things that are literally just going out of business.
Yeah. And then, what is FRC again? First Republic.
Yeah, it's a San Francisco-based bank. I guess this is the one Mark Zuckerberg personally uses, is one of the articles I saw talking about.
Yep. Yeah. It's they also had kind of a weird day, right? They had this is manipulation. They had a 95 to 45 and backup day. I mean, I don't even know how you do that. Yes, my face is covering the volume bars. It doesn't matter. It's just a big bar for all these. You can't tell. But
it's such a big bar that you can barely see the ending of the other volume days.
It's pointless. You don't learn anything from that. The two most interesting ones, Amir, JPM, you can see that they're showing relative strength in the industry, and Schwab. They are getting hammered, and they fell below this kind of terrifying level of 60. So those are the two I have my eye on right now.
Yeah, all right, interesting. I'll have to do a little bit more looking at Charles Schwab. That's who I actually invest through, so that's a little scary. But I'm under the FDIC insurance limit anyway, so
you're set.
Still, yeah. Well, yeah, I don't want to deal with that though. Do not want to deal with that. That's definitely scary.
Give us a like and subscribe, guys, if you appreciate Vinny going through that. I don't know any of that stuff, so thanks, man. We appreciate it. Have a good one.
Catch you next one.